Immediately start with the stock. It looks like a very nice hockey stick. So Apple did really good, especially after the 2019 China scare, and then also as working from home and more devices are used, Apple did really amazing. The current market capitalization is 2.82 trillion, which is good for comparisons later in the valuation, and the price earnings ratio pretty straightforward with Apple is 28.71, and dividend yield is low because Apple focuses on buybacks, thus it repurchases more of its shares so that the number of shares outstanding is smaller and smaller, and you own more of the company, which increases earnings per share growth over time. And now many would say that the stock is high. Of course, when you compare it to where it was when I first analyzed Apple here in 2016, so I wrote this article, price earnings ratio was 10, it was cheap, I even bought there. Now, of course, the story is different, but as investors, we must not look at what happened in the past. We must look at the risk and reward now for the future. So let's immediately start with the key business factors. And the key business factor for Apple is, of course, the ecosystem. Now, Apple iPhone products, I'm using an iPhone 7 now to film this, and you see that products and hardware are still the core of the business, but services are growing pretty fast. So now services are almost 20 billion, 15% of sales, but growing pretty fast. That's 20+% per month. And the key of Apple is that net income is 27.9% of revenue for the last quarter. And this shows that Apple is a great business that has strong pricing power and extremely high margins, where people, once in the ecosystem, are happy to pay a premium to be part of that ecosystem. And that is something rare when it comes to business. The key, of course, now for Apple is what will be the growth ahead. We have a great business, we have great earnings, great income, everything looks great, great margins, great products, good growth. And now the question is, okay, the key question for the business is what will be the growth ahead? The last 2 years have been extraordinary because of the conditions we were living in and the demand for devices, but Apple expects growth ahead, and now we have to see what kind of growth ahead in our valuation. Over the last decade, if we look at growth, revenues have more than doubled over the last 10 years, which is growth in the very high single digit. Of course, these last 2 years have really seen exploding growth, which is a positive as the company increases its ecosystem on which to build on further. On growth ahead, of course, Tim Cook says that they now have 1.8 billion devices in use. I remember when I analyzed it, they were aiming for 1 billion, so that is a huge growth in number and in huge growth in strength of the ecosystem. Luca Maestri, the CFO, discussed how they reached an all-time revenue record for services, up 24%. So on the hardware, on the ecosystem, they are building this software, let's say, selling and others, cloud services, music, video, that is really growing high. And if they can keep that ecosystem, then they have further growth ahead, as this is still a small and growing fast business. Plus, on top of the revenue, they now have more than 785 million paid subscriptions across the services on their platform, and up 165 million during the last 12 months. So huge growth there, on which you can bank later by increasing the number of services and other related sales. What does the management expect on growth? They don't give guidance given the conditions, but they expect to achieve solid year-over-year revenue growth for the coming quarter. However, they expect the revenue growth rate to decelerate from the December quarter because of two factors: huge revenue growth, as we mentioned, over the last 2 years, and then different launch timing, some forex issues, etc., but not that significant. And now here is a concept that few look when it comes to Apple because Apple doesn't speak about this. But a great question in the conference call came on spending. You folks are spending, I think, 23 billion on research and development in 21. So you're really spending a fair amount. And would you tell us what will be the next product? Of course, Tim Cook replied that they prefer to keep it secret and only then launch with a bang. 23 billion is a lot of spending, so we might expect something new to be added to the Apple ecosystem on the 1.8 billion installed user base, devices base. That means that there is plenty more of room for Apple to slowly and steadily grow over time. Of course, there is always the Apple cycle that one needs to keep in mind, but that might give opportunities to invest more in the future. Now, here a touch on learning from listening to these conference calls. The question was about China, the macro climate there, and how that fits Apple's business. And the answer was pretty straightforward, that they had record sales in China, top sold devices, and when people in a country buy Apple phones like crazy, it means that things are not that bad in that country. So this is a real business input that you have, no matter what the media and the news likes to present us. So the thing is, okay, one input, and then you build a picture, but one input that I take from this is people are buying a lot of iPhones and Apple stuff there, which means they have money and they feel good and confident. Now, when it comes to stock valuation, we have three key factors to look at. Growth, cash flows, of course, or net income. It's the same with Apple, as I said, pretty straightforward. And a factor big with Apple are buybacks. As I said, with cash flows and net income, whatever you take here is pretty similar, pretty straightforward. So really, really good earnings per share, 100.5 billion in net income, 101 in free cash flow. Of course, most of the money is used to do repurchases, 20.5 billion in the last quarter, and the symbolic amount for dividends, so 24 billion times 4 over the year. Though they spend their free cash flows on repurchases and dividends, so 100 billion to be rewarded for the shareholder. And the number of shares has been constantly declining over time. This is the power of buybacks, and as Warren Buffett says, if you keep doing like that, I will be owning the only remaining share of Apple once the company buys them all. And consequently, of course, you see the power of buybacks here as more and more cash flows flow in. That is this hockey stick. Earnings per share for input, so $6.03. Let me go to my comparative table. You can download this with a lot of stock examples, and I will be filling all the new analysis here. PayPal stock is coming tomorrow, so you might want to enjoy that too. Apple, click on the valuation table. I have already put in cash flow per share, and then with growth of, let's say, 8% per year, and with a 10% expected return, here I have taken the present value times 13% of the cash flows, because that's usually what they pay out in dividends, so that's what you get on your account. And for an expected 10% return with a terminal multiple, so a price-earnings ratio of 20 in 10 years, then the intrinsic value is $100 per share. This is, of course, way below the current stock price, but let's do the exuberant or best case scenario for Apple, and then you see that the present value is close to the stock price. So if they grow 10% per year over the next 5 years, 8% over the subsequent 5 years, 10% expected return, and the key is that the current price-earnings ratio of 28.7 doesn't change, then if that all holds, then you'll have a 10% return from Apple stock, including the dividends, where if you buy it now, over 10 years the stock price will likely be around 400. What have I included here in the estimations? Growth of 5% from the business, current cash flows 100 billion or $6 per share, and 4% from continuation in buybacks, because the buybacks increase the earnings per share because there is less and less stocks out there. So total 9% growth, 6 per share, and you get to this valuation. Of course, if things turn south, there is a lower terminal multiple, then the present value is much, much lower, which is something I would call the risky margin of safety scenario. You can download this template, play around. You can also check my videos for the indications on how to use it if you want to learn more. Now, on the risk and reward, I think Apple is, if not the best business, among the top businesses currently in the world. High margin, strong ecosystem, strong moat. You stick to an Apple once you have it. Extreme customer satisfaction that we have heard in the conference call, off the charts, as they said. But on the risk situation, the key risk is the valuation. Even if, okay, 28, likely as growth comes 25, that's a 4 or 5% return, plus 4 or 5% growth, you have a great return of 10% per year. So that's nothing wrong with that. Of course, the key difference is if the valuation changes, if the market goes back to a P ratio of 15, then it will not be that good for Apple. But that's the risk and reward of investing in Apple. All else equal, if things remain as those are now with valuation, you can expect a 10% long-term return, yearly return from Apple. So there's nothing wrong with Apple. The key risk is always the market. Of course, my valuation is pretty conservative, and if I compare it to all the other stocks there, so it is perhaps on the most expensive side. But you see, Apple 6%, expecting a conservative multiple, because you never know when these multiples can change. But if Apple has some bad earnings, a bad year, like it was the case in 2016, I am sure I will take another look and perhaps even buy it. I don't own it, but it's a great business, nothing wrong with it. A little bit high valuation, but the greatness of the business might be worth it to pay a premium for such a good business. Let me know in the comments what you think. If you're interested in more valuations and analysis in my portfolios, check what I do. Thanks for watching. I'll see you in the next video tomorrow.